back to another week, and this week is a special edition, and we are going to be talking about our portfolio holdings at Investonomics. So we're going to walk through each of the positions we hold, what we plan to hold in the future since our portfolio isn't fully built yet, and we're going to give you guys some insights in terms of diversification and why we chose the specific ETFs and stocks that we are holding. So I hope you enjoy this one, and I'll see you all next week. Hey everyone, and welcome to a special edition of the weekly lecture where we talk about our post-COVID portfolio for 2022. Navigating the pandemic in terms of investments, and not to mention everything else, has been nothing short of complicated and confusing for everybody globally. At Investonomics, we believe that the key to succeeding in any type of market, including the pandemic, is through the art of diversification. I've talked about this a little bit before, but we'll talk about it more in this video. Although holding single name stocks, which is just stocks that you talk about in everyday life and companies, they can be explosive in terms of growth in some situations. Holding only single names is pretty risky. If you do choose to hold these single name stocks, which is again stocks like Apple or Tesla, ensure that you really believe in the company or have extensive knowledge about the industry and how that company operates in the market. And having this knowledge will aid you in knowing when the company is in trouble or no longer has serious growth potential because you're familiar with the market it operates in. Now, generally speaking, we love sticking to index funds here at Investonomics. They are very powerful funds, and they often capture the movement of hundreds of stocks in a single ticker name. And this actually gives you instant diversification through buying the index fund rather than buying multiple stocks and hundreds of them. And you can do this simply by clicking buy on your broker platform. And it also eliminates the need to deeply dive into research for single companies. We'll talk about SPY, or the SPIDER. This is the ticker for this index fund as an example. And it's the index fund tracking the S&P 500 index, which are the 500 largest American companies. By buying SPY, it means you automatically diversify over these 500 companies, and it's like owning a small part of each one of them, which is the beauty. And another good way to diversify is by utilizing sector-specific index funds in your portfolio. It can also be useful to consider various regions of the United States, or various countries or regions in the entire world, and even specific industries within the country or globally. Now what this does is it adds to diversification and can allow you to capture gains in various sectors or regions. And it has been technology that has recently been growing a lot, which would have boosted your portfolio due to stocks like Tesla and Apple. So this shows that buying industry-specific ETFs can pay off as well. Now, we're going to be discussing our current holdings here, and we haven't quite completed our portfolio with all the holdings, but we'll still give you a good idea of where to start for yourself. So here's our holdings as of 2022. Now the first holding is a little bit more of a risky one, and it's a single name stock called Dragonfly. It's a drone style delivery company for delivering online packages such as for Amazon or eBay, and they signed good contracts to implement their services with both the government and private institutions. So we have a small position to see it through, which is roughly 2% of our portfolio. And of course, never put too much of your capital into risky plays, just do it if you see potential. The second is American Airlines. We believe the airline industry is at an important turning point since COVID hit. In recent weeks, it's been pretty terrible, and it's been doing quite poorly, but we believe this will turn around at some point. And these are likely to do well in the coming years, so it's definitely a longer term play. And it's a fairly low risk company as well, not very easy to hit bankruptcy, and it's about 10% of our portfolio. Next we have Apple. We hold this as well, and it's a stock that almost all investors should be holding at all times. It has been growing steadily since about 2005, very stable and very large company, and it is less risky than American Airlines or Dragonfly. It makes up a larger chunk as well, about 10% of our portfolio. And again, this is a very stable company to invest in. Now, it's important to note that the rest of our holdings are ETFs. As we increase the number of holdings, we'll be actively switching to more ETFs and less into stocks, individual names. And this is simply for diversification and risk diversification. So the first, of course, is SPY, which is the SP 500 index fund, or the SPDR as we've mentioned. And this has returned more than 25% this past year. And this isn't average at all, just thought I'd point this out, but it is been a great holding this past year. And it's also a great index fund to buy consistently and to dollar cost average into. Now, the next one that's a little bit related to this, but it is the QQQ, and this is the Invesco QQQ Trust. This sounds complicated, but it simply tracks the tech-heavy NASDAQ index, which includes holdings such as Apple, Tesla, Microsoft, and Google. Usually the growth of the NASDAQ exceeds that of the S&P because it's tech-heavy, and it's great for technology diversification, and we like it since this channel is quite tech-focused. The next one is ARK, and this is the ARK Innovation ETF, and it is made from hedge fund manager Cathie Wood, and she has a variety of ETFs that have all done surprisingly poorly during the pandemic. The focus is mostly on technology, pharmaceuticals, and scientific development, hence the innovation name. And the top holdings include companies like Tesla, Roku, and Teladoc Health. So it's not quite a technology ETF, it incorporates a little bit more. Now next is VHT, a Vanguard Healthcare ETF, and this focuses on the booming healthcare sector, especially throughout the pandemic. This has done great. Captures various pharmaceutical, health technology, and biotechnology companies, and some of these include Johnson & Johnson, Pfizer, and Merck. All of these are fairly large companies, and again, there's multiple more in this ETF. Now another one is the S&P 500 or SPDR Aerospace and Defense ETF. This fund actually closely follows the S&P Aerospace and Defense Fund, which closely tracks various national defense companies for the United States, and it's related to the military. So it is steadily appreciating and been interesting to watch actually as the Russia and Ukraine rivalry and invasion unfolds. And of course this is because it's defense. Now the last one that we have here is VNQ, and this is the real estate ETF from Vanguard. And these Vanguard ones are really good because they have low expense ratios, which is very important long term. And it tracks the USA real estate sector by closely following various real estate investment trusts, or REITs as they're called. It also includes various real estate benchmarks and indices. Its focus is on growth and on longer term performance. So those are our holdings for 2022. Our goal is to slowly dollar cost average into these positions, and especially the ETFs more so. We are happy with our single name stock positions, and we want to add various additional ETFs, including various regions of the world, different sectors in the United States, such as we want to get into metals, and potentially more into aerospace and the space sector, and emerging or developing market indices. These will provide more diversification. So we hope this has provided some insight and pushed you to start your investing journey. Always be sure to do your own research, however, and don't just copy our positions. This is the worst thing you can do for yourself and for everybody else. Use them as a starting point, and simply as that, to build and then branch out and curate your portfolio to your own personal risk tolerance level. This is the best way to do it. The key is not to beat the market, but rather to add money every month, and the average price will average out over time, making you higher returns and matching the market, which is the best you're going to do. It will also compound much faster if you add money every month. So see you guys next week.